Welcome to Make It Last, helping you keep your legal ducks in a row and your nest egg secure, with your host, Victor Medina, an estate planning and elder law attorney and certified financial planner.
Everybody, welcome back to Make It Last. I am your host, Victor Medina. I'm glad you could join us this Christmas week. Airing of this show, it's December 23rd. I've got to be very honest. Well, it's Saturday the 23rd, and you're maybe listening live on the radio. I am not in the studio right now. We've pre-recorded this show, but I do want to tell you a little bit about what's going to be coming up, because I'm excited for this show. I'm going to cover 5 retirement fees you should never, ever pay, as well as your charitable giving. I mean, it's the season. It's the Christmas season. We think about giving, and so I want to make sure that you understand as much as possible about how to give in a way that doesn't run afoul of the IRS. Many times we do this giving to make sure we get some tax benefit out of it, and the government's helped us out with that, but we want to make sure that we do it the right way. And so one of the things we can do is kind of think about that there is going to be some time for you to complete some charitable giving by the end of the year if you want it to count for this tax year. So if you listen to this on the 23rd or soon afterwards, I tell you, you can take advantage of it. Now, if you want to make sure that you get every single episode of Make It Last and you don't miss on a single one of the things you can do is go ahead and subscribe to the iTunes or the Android feed on that. And so we are available on all of those platforms. If you just search for Make It Last with Victor Medina, you'll see a blue square, which is our logo. It says Make It Last. And you just hit on the subscribe button. And that means that every episode would be delivered to your inbox, and so that you can listen to it at your leisure. Whether or not you are available on Saturday or some afterwards, the show is available immediately after broadcast at 8 o'clock in the morning on Saturday. So you'll have it just as soon as everybody else has had it, and maybe your coffee will taste a little bit better if you slept in a little bit more. Another thing that we're happy to announce is we are actually part of the Spotify platform now. So if you are a subscriber to Spotify, you can search on there and actually follow the show. And following is their kind of term of subscribing. And what it'll do is you can look, and the moment you go to the show's page, you can see all of the prior episodes, which means you can play all of them at your leisure. So anyway, that's available to you as well. So listen, I wanted to talk to you first about 5 retirement fees you should never, ever pay. Now, some of these I've covered in the past, and this is the first time I'm sort of consolidating them here in this idea that these are ones that you can absolutely avoid. And so maybe you want to take a notepad and a pen and make sure that you write these down, and make sure that in your retirement life you are not paying these fees. I mean, retirement in and of itself is a complicated matter, and it is kind of easy to trigger some of these fees. But those people who are paying attention to their planning, maybe those of you who are working with a great financial advisor, you can help avoid these. And so this is a list of 5 of them. Now, the first one has to do with 401k or IRA early withdrawal penalties. As you may know, there is a 10% early withdrawal penalty for IRA distributions that are made before 59 and a half, and 401k distributions made before age 55. And that penalty is applied in addition to the income tax that you owe on taking that money out. Because remember, that 401k or IRA money is tax deferred, which means that eventually the tax is going to have to get paid. Now, there are a number of ways around that penalty, even for people who need access to that money early. In a 401k, you can take a loan, which allows eligible employees to take up 50% of their vested value, up to $50,000, without any penalties or tax consequences. But you have to watch out. There are some loan fees, and the loan may be due if you leave your job, so you want to be careful with that. And there are also exceptions to the IRA withdrawal penalty. That penalty doesn't apply if you're using the money for qualified purposes like a large medical expense, health insurance after a layoff, college costs, or your first home purchase. And another little wrinkle is, for people who need income immediately, those people who set up regular annuity payments or structured payments over their life expectancy, they're not going to get charged the 10% penalty. So those are a couple of ways of kind of getting around that. And, if you have a Roth accounts have a lot more flexibility for people who need that money earlier. They can take an early withdrawal without being subject to a penalty, as long as they don't withdraw more than the amount contributed to the account. So you want to be careful on that as well. So the first one is the IRA and 401k early withdrawal fees. You want to make sure that you avoid those. The second one is the penalty for skipping a required minimum distribution. I did talk a couple of shows ago about some end-of-the-year tax planning tips, and one of them was to make sure that you take your withdrawals from your accounts. Now, as a reminder, annual withdrawals are required for people that are older than 70 and a half. And so for those people that are older, the RMDs have to be taken by December 31st. You can't take them between January and when you file your taxes. It has to be done before the end of the year, and the income tax is due on each of the withdrawals. Now, the penalty for missing a withdrawal is 50% of the amount that should have been taken, and that's on top of the income tax that's due. So if you think about that, if you were supposed to take $2,000 out and you were in the 25% bracket, so what ends up happening is that if you don't take that money out, you owe $1,000, 50% as a tax, as a fee for doing it. But you also owe the 25% of the $2,000, or essentially $500 as income taxes. So that's a lot of money that's supposed to be eaten up, and you want to make sure that you avoid that. So as a reminder, we look at these RMDs as part of our financial planning practice back in September. And so we want to make sure that we're nowhere near the end of the deadline. And when I go into another portion of the show, we're going to talk a little bit about how you can take those distributions and contribute them to a qualified charity and not have to pay income tax, but you still have to take them out before the end of the year. So you just have to make sure that you're avoiding that penalty. The third fee that you should avoid is the Social Security early enrollment penalty. So you can start your Social Security as early as 62, but your payments are reduced if you sign up before your full retirement age, which is typically 66 or 67. It's been graduated up depending on your year of birth, right? If you begin collecting at 62, you will get 25% smaller monthly payments if your full retirement age is 66, and you'll get 30% smaller payments if your full retirement age is 67. Now, you do want to be careful here, and I hate throwing financial advisors under the bus, but many times the advice that you're receiving about taking Social Security early is because they want to avoid you taking money out of the account because they get paid on how much money you have invested. That's not really working in your best interest. In your best interest, one of the things you want to think about doing is, in fact, delaying the Social Security, because not only will you avoid this penalty for starting early, but if you can delay it between your full retirement age and age 70, if you can allow that to accrue, you will actually increase that benefit by 8% per year, which is the best return guaranteed that you could ever get. And so you want to make sure that you are taking advantage of that if your cash flow permits it. And it's one of the things a planner should help you do, is understand that you can make withdrawals from your savings in order to allow your Social Security to accrue. Now, if you sign up for Social Security early and you regret it, you have a couple of options. You can change your mind within 12 months of starting the benefit, and you can repay all of the money you received. Then you withdraw your Social Security application and then apply for the higher payments later. And another thing that you can do to increase it is you can continue to work in retirement. And so if you earn more towards the end than you did earlier, you can replace some of those lower years of earnings, because the amount that you're going to get from Social Security is calculated off your highest 35 years of income. And so if you had some 0 years of income, or if you have some income where you're just starting and it's not as high as it was now, working longer can actually have an effect on what your benefit will be later in the future. So those are 3 retirement fees that you should avoid. When we come back, I'm going to cover 2 more and then transition into talking about some charitable giving and how you can make sure that the charitable giving that you do doesn't run afoul of the IRS. So stick with us on Make It Last. We'll be right back after this break.
Just about every working American stays focused on the ultimate goal, retirement. But planning for it can come with a lot of uncertainty. Do I have adequate savings? Have I invested enough? Have I invested too much? What's the right thing to do? If you're one of the millions of Americans asking these questions, let financial expert Victor Medina help you make sense of it all. Victor is a certified financial planner and retirement income specialist who can help you set the strategy with a unique planning process that centers on you. By taking an in-depth look at your retirement timeline, goals you want to achieve, and what you have saved, Victor and his staff can help you figure out how to get the most out of retirement. Retirement is the biggest financial decision you will make. Putting the right plan in place and sticking to it is the smartest decision anyone can ever make. To learn more, visit Private Client Capital Group online at privateclientcapitalgroup.com and start down the path of securing your total wealth today.
Hey, welcome back to Make It Last. You know, we've been covering 5 retirement fees that you should absolutely never pay in retirement. Ever. You should avoid paying them, and you can avoid paying them with some smart planning. We've covered 3 of them so far. We've talked a little bit about the penalty that's for early withdrawals from 401ks and IRAs. It's withdrawals that you take out if you're younger than 59 and a half. We talked about the penalty for skipping a required minimum distribution. Those are the distributions that you have to take after 70 and a half, and those have a 50% penalty, so you definitely want to make sure that you avoid those. And then we talked about some Social Security early enrollment penalty, which is really a reduction in the amount of Social Security that you get for your life. 25 or 30% depending on your full retirement age. And, certainly there's some planning situations in which taking it early makes sense. If you've been diagnosed with a terminal condition, if you have, some sort of illness that's going to shortcut your ability to receive the Social Security benefits, you have that. It's not an all or nothing proposition, but for most people that are going to live, to being 80 years old or more, taking Social Security early is really not a good idea. Now, there's 2 more, and there are 2 of my favorites. One's a little-known one, and the other one is one that I have been banging on the bell as hard as I can since the beginning of this show, and every meeting that I have when I meet with clients as their financial advisor and as a lawyer, just kind of looking out for their best interests and telling them what they should think about for retirement. So the first one that's a little-known one is a Medicare late enrollment penalty. Now, we're working longer and longer, and people are being covered by their old employer, or they might have a pension benefit if they work for the state. And so this can get a little bit complicated. But it is important for you to sign up for Medicare when you first are eligible to do so, beginning 3 months before your 65th birthday or within 8 months of leaving a job with group health coverage. If you sign up later, the Medicare Part B premiums increase by 10% for every 12-month period you delayed enrolling in Medicare after becoming eligible for benefits. Now, it is important to make sure that the group health coverage has a substantially similar coverage to Medicare. It's going to be one of the tests, and so you're going to have to ask your employer for their letter that says that Medicare has deemed that health insurance is substantially similar to what you're getting in you would be getting in Medicare. But once you have that letter, it's okay to still be covered by this group policy. But when you separate from service or you lose that, within 8 months of doing that, you have to sign up for Medicare Part B or else incur a 10% premium increase for every 12-month period. Medicare Part D penalty is a little bit different. It begins if you just go 63 days without a prescription drug coverage after becoming eligible for Medicare, and increases the longer you go without coverage. And that penalty is added to the premium for any Medicare Part D you select. Remember, you can go into the plan finder at medicare.gov and put in your drug list and how much you take, and it will give you kind of the least expensive option for coverage depending on which retail pharmacy you want to go to if you're going to get it in mail order. But that number does not include any penalties that you might have to pay for Part D. And so you want to make sure that you avoid that penalty. And then finally, related to Medicare, you only have a right to buy a Medigap policy during the 6-month period when you are 65 and older and enrolled in a Medicare Part B. After that, the private insurance companies that offer the Medigap policies can charge you significantly higher premiums or even deny you the policy. You may not even have one available to you. So it is important to sign up for these various parts of Medicare during the months around your 65th birthday, and failing to do so can increase the premiums fairly significantly. And then finally, and this is the one that I've been hitting on over and over and over, these are high expense ratios for your investments. You can't control at all how your investments are going to perform. No one can give you a guarantee that your mutual funds and the things that you buy are going to go up or go down. No way at all. But you do have a measure of control over how much you pay in fees and other investment costs. So, and this is one of those things where most of the knowledge is still behind A lot of people understand buy and hold. They understand long-term investing. That information is trickled down to them. But there was a recent survey and of about 3,000 different private sector workers, and it found that over a third of them aren't familiar with the fees that they're charged in their retirement account at all. In 401k plan sponsors are required to provide fee information for every investment option. And if you are not in a 401k and you've rolled it over and you're working with another advisor, they may not be disclosing the expense ratios in there. So you could take the investment portfolio and you can look it up on Morningstar, or you can come to an advisor like me, and one of the first things that we'll do is examine your expense ratio to see if you're getting charged too much for your investments. But the savings that you have in the expense ratios will compound over time. It's the same amount of compounding that is available to you just for the growth of the investments. The savings gets compounded, and I'm pretty famous in my talks about showing a comparison between an average mutual fund ratio of about 1.44% and our blended ratio of about 0.33%. And the difference between the two is a savings of almost 20% or a growth of almost 20%. So it is important to look at that. I mean, you might even include these concepts of fixed indexed annuities, which we use from time to time, which have no fees associated with them, or the fees that are associated are in exchange for some contractual benefits. But the idea is that the growth itself is going to continue to get compounded. So again, you want to avoid these expense ratios because they can be high and they can really impact it. So to go over the 5 again real quick, we have our early withdrawal penalties from 401ks. We have the late withdrawals on the RMDs, early enrollment in Social Security, late enrollment in Medicare, and excessive expense ratio. So those are the 5 retirement fees that you should absolutely avoid. Now, I'm going to go into some discussions on charitable donations. And whether you're giving money to a religious organization or for medical research or to save the elephants, you need to remember certain guidelines if you want to be able to take a tax deduction when you file your return in the next year. And while you can make these donations in cash or by check or with credit cards or payroll deduction or anything like that, it's going to be important for you to hold on to the proof because the IRS is not going to take it on, pardon the expression that we're talking about it as a Christmas thing, but on faith that you dropped $10,000 into the collection box on your way out the door. So the burden on proof for every deduction falls on you and the taxpayer. So when we come back, I'm going to give you the rules on how to give to charity in a way that is tax deductible, and that way you can make sure that you're in a great position coming up to the end of this year, and we can do something Christmassy, which is basically think about other people and giving to them. So we'll be right back on Make It Last just right after this break. Thanks.
As you get older, there are so many decisions to make around your legal, financial, and tax planning needs. Searching for the right people who you can trust and getting them all on the same page can be frustrating and exhausting. Turns out, now there's a better way. Medina Law Group is the only place where you can secure your total wealth with a one-stop shop for your estate, retirement, and tax planning needs. With over 15 years of experience and more financial credentials than you can shake a stick at, Victor Medina and his team offer a way to cover all of your planning needs under one roof. Whether you're concerned about getting your ducks in a row or securing your nest egg or both, Medina Law Group can give you the peace of mind you deserve to make sure you have all the angles covered with best-in-class planning. Call the experienced professionals at Medina Law Group at 609-818-0068 to learn more, including your chance to schedule a free consultation. You can also visit MedinaLawGroup.com to learn more about protecting your assets and the Medina Law Group team. For peace of mind and a solid foundation, contact Medina Law Group today.
Hey, welcome back to Make It Last. I'm talking to you about how to make charitable deductions in a way that is tax deductible. And it is important for you to kind of think through these issues because we want to make sure that all of your giving has the ultimate, optimized benefit, which can include some tax deductions. And surely you can give without thinking about the tax deductions, but, hey, I'm a lawyer and a financial planner, so if I'm going to talk to you about this stuff, I am going to talk to you about doing it in a way that is tax deductible. So one of the first things we want to make sure is that you are giving to a qualified charity. A lot of times people just think about charitable organizations without thinking about their tax qualifications. And so one of the things you can do is go to the IRS website, and you can go to a website called Select Check. And Select Check, it's at the IRS, it's the charitable nonprofits. And one of the things you want to do is go ahead and look at making sure that they have tax exempt status. So it's the EO Select Check, which is the exempt organization Select Check. And it's a search tool that allows you to search for and select exempt organizations and see, what their filing status is. And it'll give you an opportunity to make sure that what you're giving to is a qualified charity. Now, they list most organizations. If you're giving to a religious or government organization, you're pretty safe in taking the write-off. But you want to make sure that you have checked on their status. Now, a little wrinkle on the way that you can give. We've talked to you a little bit about, you can give it in cash and check, but if you made a year-end gift on your credit card, you can take the deduction in the year that you hit the send button, not when you paid the bill. And it's the same thing for checks that were mailed before the end of the year. As long as you mailed the check before the end of the year, you can take the deduction regardless of whenever the charity received or cashed the check. And for those who are always looking at an edge, mailing the check in the new year with a pre-dated check is probably going to get you caught. If the charity receives the donation, in February and processes, it's probably unreasonable to assume that you mailed it before the deadline. But if you're coming up near the deadline and you want to make sure that you're able to take the deduction, but you're concerned, if I put the check in the mail, but they don't, they're closed for the rest of the year and they don't cash it until the first or second week of January, can I still take the deduction? And the answer is yes, you can absolutely take that deduction if you've gone ahead and sent and mailed it beforehand. And certainly if you paid it by credit card, even if you don't pay the credit card bill till a little bit later. But you, of course, sound financial planning, make sure you pay all of your credit card bills off in the next month. We don't want to give the credit card companies any unnecessary interest on their money. So a couple of things that we need to remember, especially for those people that are a little bit higher income, the deduction for the charitable donations can only be taken on Schedule A of your 1040. So if you can't itemize your deductions, there's no place to take the deductions on the rest of the tax return. So another way to think about it is if you take the standard deduction, for people who can't itemize, it's assumed that you're taking a standard amount of charitable donations. So again, if you can't itemize, you can't take advantage of any further charitable deductions. Now, there are special rules when it comes to donations of property, including things like your clothes or household items. And the IRS website provides details for taxpayers who, give old clothes, sofas, cars, or boats, other things. You have to keep a receipt from the charity that they received it, the date of the contributions, and the detailed list of the items donated, and what is the fair market value. So it's not uncommon for taxpayers to get creative with the value of the 30-year-old, Gucci leather belt. But if your assessment crosses that threshold of reasonableness, you can expect to get called out on that for how much you are claiming. If it's something like your boat or a car, the deduction is usually limited to gross proceeds of the sale of the asset. So you might have, an absolute clunker that might have a book value of $2,500, but if it only brings $500 in a sale to the charity, you can only take the $500 deduction. And again, written documentation is important. So those are a couple of rules on, how you can make gifts to of your items. When you start thinking about gifting to charities appreciated stocks, the rules can get complicated. And, this is a point where we're going to recommend that you talk to a financial planner and or a lawyer about it. There are ways of getting deductions off of that and even exempting the total gain off of it while still receiving some money back. That concept is called charitable remainder trust. And essentially the way that it works is you can take your highly appreciated stock. Let's say that you got stock years and years ago for very low low basis, and it's appreciated a lot. Now, normally when you sell all of that, you would contribute it inside of, you'd have to pay capital gains on all of the growth. But if you've contributed to a qualified charitable remainder trust, what you can do is you contribute the shares, you sell the shares don't pay any capital gains tax. You're allowed to take what we can call an annuity payment, and it's an annuity in kind of like the small a version. It's just a structured payment over time. And so what you're doing is you're taking an amount, let's say 5% out annually for a period. At the end of it, whatever's left over, whether it's 10% or a lot more of the original value, all of that goes to charity. So if you're already charitably inclined, you can use this structure to not only exempt the sale from any income taxes, specifically capital gains taxes, but you can also get an annuity payment out of that. You can get a structured payment to come out of it, which you can use and spend. And so it's a great, powerful planning tool because there are some rules. You have to make sure that a minimum of 10% goes to the charity of whatever's left over. And if you don't, then if that doesn't happen, you can have a problem. So you want to make sure that you don't deplete the entire value. But it is it's a really interesting way for you to exempt this sale of taxes. And, usually it's worth paying a planner and an attorney to get that done because the amount that you can save in taxes is pretty powerful. So that's a little primer on charitable deductions. There are some rules about the number of years that you can take a deduction and depreciate over 5 years and as a percentage of your income. That gets a little complicated, a little too much for a 30-minute radio show. But I do want to let you know that you always have the opportunity to counsel with somebody who knows about this, a CPA, a tax planning attorney, or a financial planner that can help you understand how to make sure that your charitable deductions are things that you can take full advantage of, not only helping other people, but also paying less in taxes, which allows you to have more money to help more people. So helping others is always a good thing. Feeling the feeling that you get from providing aid to great causes touches our soul. And getting a deduction for your generosity is just that little sweetener that comes back. So you just have to make sure that you follow the rules on it. So that winds up today's show. This is sort of our Christmas episode. I really hope for all of you, if you celebrate Christmas, you're doing it with your family. If you don't celebrate Christmas, you have had an opportunity over the course of this holiday season to be with family and understand those things that we cherish most, which is the opportunity to interact with others, see what we're grateful for, help other people when we can. And those are really the things that kind of make for a great life. I'll leave you with this quick story. I recently went to go kind of with a coaching program for other attorneys that are looking to make their practices better. And it was a summit of all of these attorneys that came together because they have these different programs. And once a year, they bring everybody together. And there's a room full of, probably 80 or so lawyers, which is pretty big. And what was unique about this gathering is that everybody there really was focused on making great lives for themselves, making great lives. And I don't mean financial. I mean in the way that they help people, making great lives for their teams, people that they work with, making great lives for their clients, and also making great lives for each other. And so it's rare to be in that group. And I just kind of stepped back, especially seeing, people that I know, people that work on my team, help other people and participate in this. It was really nice to take a step back and kind of marvel at the wonder of the goodness of humanity. You had all these people here who that was their focus, and decided that those are the people I want to be around. And I want that for you as well. I want you to really kind of have an opportunity to share in that with other people. So that's the little Christmas message that I'm leaving you with. Now, when we come back, we're going to have one more show before the end of the year. We will celebrate year end together. And we, as always, we're here 7:30 in the morning on WCTC 1450 AM. We are simulcast as a podcast, and you can see that on iTunes, Android, and now you can see it on Spotify. If you just search for Make It Last on Spotify, our little blue blocks logo is right there at the bottom. Now, if you like the show, what I can ask you to do, please, on behalf of us, is just share it widely. Our listenership is growing and growing and growing. We watch the numbers and the number of downloads on podcasts, and so we want to help spread this information, something we do for free. We give this information freely to anybody that wants to listen, and we think that's great information for other people to know. We want you to share that with somebody. So that's it for this show. I want to thank you for joining us. This has been Make It Last, where we help you keep your legal ducks in a row and your financial nest egg secure, and we will catch you next Saturday. Bye-bye.
The foregoing content reflects the opinions of Medina Law Group, LLC, and Private Client Capital Group, LLC, and is subject to change at any time without notice. Content provided herein is for informational purposes only and should not be used or construed as investment or legal advice or a recommendation regarding the purchase or sale of any security or to follow any legal strategy. There is no guarantee that the strategies, statements, opinions, or forecasts provided herein will prove to be correct. Past performance is not a guarantee of future results. Indices are not available for direct investment. Any investor who attempts to mimic the performance of an index would incur fees and expenses, which would reduce returns. All investing involves risk, including the potential for loss of principal. There's no guarantee that any investment plan or strategy will be successful. We recommend that you consult with a professional dedicated to your needs.